with interest rates, it goes in eighths. And 1 point typically will get your rate a quarter of a percent lower.
Someone had to ask. I'm Amy Viaglia, and this show is built on one idea that good questions asked of the right people make all the difference. Each episode, I sit down with someone who has the expertise most of us don't, and ask the questions you might not know to ask. Someone had to ask, so I did. Back in episode 1, Jay Sills with Barrett Financial Group mentioned something in passing and told me it could almost be its own show: discount points. You're sitting across from your loan officer looking at a rate sheet, and one of the lines mentions paying a point to lower your rate. What does that actually mean? Is it worth it? And how would you even know? This is the moment where a lot of borrowers just nod along and trust the number in front of them because the math isn't obvious and nobody wants to admit they're not following. So I wanted to ask Jay to slow down and walk through it. What a discount point actually buys you, and how someone decides whether it's the right move for their situation. Jay, welcome back to Someone Had to Ask.
Thanks for having me.
Jay, let's start with the basics. What
All right.
is a discount point? In plain terms, what is someone actually paying for?
Okay. So a discount point is a cost that is below what's called the par rate. So a par rate comes with no cost. So let's say, for example, 6.5 is your par rate, and 6.25 would cost a point. All right. So now, if you wanted to buy down your rate at 1 point, that's 1% of your financed amount, then your rate would typically be 6.25, a quarter of a percent lower than the par rate that you're getting. If you want to buy 2 points, it'll go down a half a percent. So in this example, you could buy your rate down to 6%, and it could cost you 2 points. So it's just an added cost to normal standard closing costs.
So it buys down the rates, but what does it actually buy someone? Like, how much will it possibly move? Does that fluctuate at all? Does it stay consistent? Or does it depend on the loan?
Well, to answer your question, discount points, what that does, if you lower your rate, you're going to have a lower payment per month, clearly, and that's going to stay that way always. And you're paying for upfront interest upfront. So they will always remain the same. It doesn't fluctuate. As far as fluctuating, there's not a set cost for discount points
Okay.
because it goes off of the financed amount. So if you're financing just to keep it simple, $200,000, 1 point would cost 2 grand, 2 points would cost four. So that would be in addition to normal standard closing cost, and that'll get you a lower interest rate. But this misconception on buying points is whenever you say you can buy your rate down and buy a point, most people would think that your rate would go from, say, 6.5 to 5.5. I'm buying a full percent down, and that's not at all the case. Well, that's a big surprise when buying discount points. That's an example of a gentleman I had just a couple months ago. We went through discount points, and he was shocked that his rate was only going to be a half a percent lower. He said, "But I'm buying 2 points." I said, "Right, but it goes down with interest rates. It goes in eighths, and 1 point typically will get your rate a quarter of a percent lower." So I hope that answers your question.
It does. Are there any situations, because I'm glad you brought that up about lasting the life of the loan. Are there any situations in which that would not be the case, where you're buying down a rate and it's only
Mhm.
for a set amount of time, but then it jumps up.
Yes, okay. There is a popular program out there now, um, and it's a 2-1 buy down or a 1-1 buy down. And those particular loan programs, you do actually buy 1 full percent down and 2% down. There's actually, you can go down to three. There's another one. It's just more expensive. You can go 3% below the par rate. So let's just, for example, I'm going with 6.5. If you did a 2-1 buy down, that means your rate would be 4.5% the first year. Okay. If you did a 2-1 buy down. So you would start at 4.5, and that would be fixed for 1 year. And in year two, it'll go up to 5.5. Then in year three, it'll be set at 6.5. It won't ever move again. Those are programs that I've done over the last 2 years that's been popular with first time home buyers. It's a good deal. The seller pays for it. That's one of the things with these type of programs is the seller has to pay for it. So it's like seller concessions for closing costs. It's the same. You could use that seller concessions to buy the rate. Okay. And then you could start off and you will save, you know, for sure, $200 to $300 or more, let's just say $200 to $400 per month in that first year. And then it'll, go down in the second year and then go to the full fixed rate in year three. So those are popular. They're good for first time home buyers, in my opinion, that are just now getting out and have their first full time job, maybe, and their income's going to go up over time. So they can handle whenever the rate goes up a little bit and their payment goes up. It makes sense. They'll make money. It's not going to affect them too much. So you can still save in the beginning, and then when it goes up, you'll be ready because your income went up. So it's a good option that I throw out there. It depends what loan officer you talk to about those. I see videos online where loan officers really don't like it, and it just goes back to what we've talked about. Everything is case by case. It depends on the person. It's not a blanket bad. Like that program is just bad for everybody. I mean, it just depends. That's why you have to go through all these options with your loan officer.
I like how you address this question about first-time home buyers because if they anticipate, got this job, they anticipate in the near future they're getting a raise or they're getting a promotion, they're going to be okay with that higher interest rate in the future.
Mhm.
It might not work for everyone who's really has this set income and doesn't anticipate it going up, or they anticipate more cost in the future, maybe a college tuition, or there's a baby on the way and they anticipate more cost. So that case by case is so very important to really think about if that kind of program would be right for that individual.
Yeah, I mean, there's one that I did for a couple that, I mean, it was $334, I believe is what it was exactly per month for that first year versus if they just went with the standard 6.5. Okay. And they're saving $334 a month, and they really liked it because, they're just starting out and they were okay with the full 6.5% payment, the full payment they're okay with. But it's like, okay, but for the first year, that's $334 less per month for a little while that we can, use towards something else. So that was attractive. It just depends on where you are in life, really.
Right.
It can fit a demographic of people for sure. So I see videos where it's just like, oh, that's just a waste of money or this or that, and you're paying for all the savings up front. Well, yes, you are. That's correct, but the seller's paying for it. I
So,
mean,
yes.
so you are negotiating that with the sales price. The seller pays for it. I mean, could you have gotten the house at a lower price? Yeah, probably. But it's a good way to save a little bit of money up front.
And that's going to be an interesting conversation when I talk to buyer's agents or seller's agents about whether it's a buyer's market or a seller's market, because these are some of those programs or possibilities when you say talking about seller's concessions. If it's a buyer's market, the seller might be more apt to make those kinds of concessions.
Yeah. Well, that's the thing, it's not like on those type of programs, it's not like your rate is going to go all off the grid to 9.5 or 8, or it's going to an adjustable rate mortgage. It's not. It's going to go to the fixed rate in year 3 if you did the 2-1 buy down. So all this up front. What's coming. There's not going to be any surprises. So that's a good option to look at. It's not for everybody, and it is more cost. You might be able to get the house for a lower price if you don't ask the seller to cover that for you. If it costs $5,000, you probably get the house for $5,000 less. So it all depends.
Yeah,
I
that's
keep saying that I'm like a broken record with the case by case. It depends. But it's so true. It just does.
there are just so many variables.
Yeah.
But okay, so let's talk about the break even point. Like, this is that part that I think trips people up the most. What would you say about break even points? What are they? And how does someone figure out what their break even point is?
Okay, yeah. So we take the difference between the interest rate that you have and like that. This kind of gets into a refinance scenario, but even with discount points, you can look at your break even point between 6% and 6.5. What the difference in payment is if you were to buy the rate down to 6%. Let's just say let's just say you're going to buy 1 point down on closing costs, and the cost is $3,000 to buy that point down. Saves you $75 a month. So to find out your break even point, you just would take that $3,000 cost, divide that by $75. That'll be your number, and I think that would be 40 months. It would be your break even point. So you just take the cost and then what the savings per month is, divide that out and get the months how long it'll take you to break even.
Okay, so this goes back to another conversation that we've had about whether it's worth it or not. So,
Mhm.
talk a little bit about the worth it question. How long does a person need to stay in a home, or what their decision-making process might be if they're going to look at maybe those break even and discount points?
7 to 10 years. You need to know that you're going to be in the home for 7 to 10 years. If not, then I wouldn't do it. If you know you're going to move, and it's not your forever home, you could possibly move in 5 years. Just get the lowest par rate you can, and go with that, because you'd be wasting money. Then that's not worth it if it's not a long term thing. So the rule is 7 to 10 years. And the other thing to think about on discount points is what's going on with interest rates today. That's all we know. Now, what do I think interest rates are going to do? I think they're going to drop 0.5% at some point. We don't know when. And if any loan officer or anybody tells you when, they know when, they're lying to you. That's an absolute joke. It's completely the most unpredictable thing, and it's been that way ever since I've been in this business. Is that we don't know. I mean, you can have economists. No, because there's no two economists that really agree. You could look all this information up online, and no two economists know. They have different answers, they have different projections. So the only thing we can do is go off of what we know today. And what I would say today to someone is to hang tight. So yeah, you want to just kind of hang tight right now, because I do think that rates will drop 0.5%. Now we don't know when. I think it would be more to someone's advantage not to buy discount points right now. But if we happen to be in a market where it looks like rates aren't going to be moving from where they are now, or they might be kind of going up, then yeah, then discount points, you're never going to lose. by taking the lower rate. The lower rate wins every time, but it's all with the risk you take is the market being so volatile with interest rates. We don't know what's going to happen in the world because there's so many factors. A war like the Iran situation spiked rates up like literally overnight. And that's been the most frustrating thing for me in 2026 is we were on a really good trajectory of rates trickling down, and all of a sudden, boom, they go right back up a 0.5%. So that's been frustrating. So that's why I say that just, right now discount points not might be worth the money because rates will go down on their own at some point. So that would be my advice as far as what's going on today.
If someone is sitting across from their loan officer, looking at the different options, what questions should they be asking you or their loan officer to make sure they understand the decision that they are making?
Well, just what the cost is and what's the break even point. And they need to know that are they going to be in the house is this a long term situation? Because you can buy points, but if you refinance in 3 or 4 years, you lose the money. You got to remember that, So it's if you know you're going to refinance, then buying discount points doesn't really make sense because you're throwing money away twice. And I hate to say throwing it away. I mean, it is going toward a good and what you want, but at the same time, that's a step you shouldn't spend several thousands on to do depending on what the market's doing at the time.
Well, and on your end, and you kind of answered this a little bit, a couple of questions. What should a lender be asking the borrower before recommending points one way or another, whether they do or don't? But what do you need to know about someone's situation to give them an honest answer? So, what are some questions you're asking?
Well, I would know what they have money wise. If they're okay with having reserves in the bank and having plenty of money for the move, then that would be someone I would propose it to. But if it's someone that is like, I have just enough for my down payment, and we've got to get help from the seller with seller concessions, and that's not really somebody I'm going to push discount points on because that's not important right now. It's just in that person's case, they just want to get in the home. Whereas, if there was maybe someone that is already owned a home and has money in the bank and they're financially okay, then discount points could be a good investment. I mean, the return is guaranteed because different, which is different than the stock market. I mean, you can look at it that way. You know that your rate of return is going to get there eventually with buying discount points. It'll get there, but it has to be a long term investment. That's number one. And again, I've already said it. If you know you'll move in the next 5 years, there's no sense in paying extra.
We talked a little bit earlier about some common misconceptions about discount points. But what's the most common mistake you see borrowers make with discount points? Like either buying them when they shouldn't or passing on them when they should have bought in. What kind of information do you make sure is on the table so that they don't make those mistakes that you've seen in the past?
Yeah, well, it just comes down to what the cost is. The discount points, if you're financing 300,000, like we were talking about, it's $3,000 if you buy 1 point. All that information has to be relayed. I haven't really had any situations where somebody's making a mistake because that's really where your loan officer comes in, and it just depends what's going on at the time and what rates are doing. Any loan officer can give you good guidance because that's what we do. We know where rates are and we know where we're trending. We just don't know when that rate drop's going to happen because it's a moving target. It's a constant moving target. So that's what we're here for. And we just relay the information and we let you decide. We don't push one way or the other. It's just, provide that information and you make the decision whether it's worth it or not. So I don't really haven't had any situations are like, oh wow, they're making a big mistake. It's not really like that, because we're so in depth with the financial situation of every borrower that I speak to. I know exactly what's going on with them, and I know no good loan officer is going to push you to spend more money than you should. So that's, I don't know if that answers your question, but it really, whenever we're talking about discount points, it's completely subjective to the time, because it all comes down to like, well, would you be open to refinance in the first year, first 2 years, 3 years? And if the answer is yes, then shouldn't really worry about discount points. Just kind of hang tight, and just refinance. And then oftentimes that it won't cost you as much in total closing costs like it would up front, because you're paying for that rate up front, or financing more to get the rate down because the seller's covering it. So just kind of got to weigh the odds.
That makes sense. Jay, I think this is exactly the kind of decision that looks simple on paper, and it isn't. It's a line item with a number next to it and a real financial choice underneath it that most people never get walked through before they get to the table, where that's what we want to do, is really lay out all of this information to help them think ahead of the game. If this gave you a way to think about that line on your own rate sheet the next time you see it, that's exactly what this show is for. If you found this conversation useful, share it with someone who's shopping for a mortgage right now. If you need help with a question that needs answering, contact me, Amy Viaclia. My contact information is in the show notes and on my website. We'll leave it there for today. Someone had to ask, so I did.